The pandemic wreaked havoc on the commercial real estate sector in 2020, plummeting it into a state of despair. However, the market rebounded remarkably in 2021, notching a historic high with sales reaching $809 billion. Now, as unchecked inflation and climbing interest rates loom, there's a growing sense that this upswing could be short-lived. At this pivotal juncture, investors are pausing to consider if this is a prelude to a market downturn. This juncture is critical as commercial real estate, typically seen as a reliable indicator of economic health, reflects broader global economic trends. The market's recovery was driven by a combination of low interest rates, stimulus measures, and a rush for space that could accommodate social distancing protocols. However, these factors are shifting. With central banks worldwide adopting more hawkish policies to curb inflation, the cost of borrowing has increased, leading to a recalibration of investment strategies. Additionally, the adaptability of businesses to remote work continues to pressure urban office markets, as demands for traditional office spaces recalibrates to this new reality. Do you want to know more about real estate investment tips? Then all you have to do is click on the like and subscribe button. Let's move on. Market analysts are scrutinizing these trends closely, aware that a sector once seen as a bastion of stability is now subject to the rapid changes of a post-pandemic economy. As these economic headwinds strengthen, the possibility of a contraction in commercial real estate investments becomes more tangible, with implications for developers, landlords, investors, and the broader financial markets. This period may well be remembered as a watershed moment for commercial real estate, marking either a temporary setback or the beginning of a more profound transformation in the asset class. Tokyo's office vacancies have surged to 8%, a stark rise from the 2% seen in 2019. Forecasts from Cushman & Wakefield suggest that even after 2024, vacancies in Tokyo's key business areas could hover around 6%. CoStar reports a steep 39% drop in new leases across Indian cities in 2021, while Toronto's core business district saw a 47% reduction. In 2021, London witnessed a contraction in its office space by millions of square feet, a trend echoed across the United States, signaling a possible downturn in the commercial real estate market. Nothing undermines property value quite like low occupancy rates, which deter potential tenants and diminish investor returns. To mitigate this, real estate investment trusts, REITs, amalgamate numerous properties into index funds, spreading risk. While this strategy can buffer against regional market dips, there's growing apprehension that commercial real estate's shelf life as a viable asset class may have expired. A notable challenge for commercial real estate this year is the spike in interest rates, inflating costs from maintenance to tenant acquisition. The U.S. Federal Reserve is wielding its most potent weapon against the fiercest inflation in 40 years, hiking interest rates. The recent back-to-back three-quarter-point rises are significant, marking an aggressive stance not seen since the 1980s. This year has seen a total of 4 rate increases, despite inflation peaking in June with a 9.1% price surge. However, signs suggest the Fed's tactics are cooling demand, evidenced by a drop in home sales due to rising mortgage rates and consumers postponing major purchases, with reverberating effects on commercial real estate. The interest rate environment can significantly impact the commercial real estate market, which is an essential part of the economy. High interest rates can majorly affect the market for commercial real estate. When interest rates are higher, the cost of borrowing money is typically also greater, which reduces demand from companies and investors. Borrowing money for commercial real estate initiatives will become increasingly expensive for enterprises. Because of this, there may be a reduction in the number of new construction projects and sluggishness in the market for purchasing existing homes. When interest rates rise to unfavorable levels, it may be difficult for firms that want to expand their operations or relocate to acquire financing for commercial property, particularly if the loan terms are not to their liking. Additionally, increased loan rates lead to higher vacancy rates and defaults. An increase in interest rates can frequently increase the vacancy rate of commercial buildings and a loss in the value of their physical assets. Existing tenants who are unable to continue making their rent payments due to high interest rates may default on their leases. As a direct consequence of this, landlords might have a tough time leasing out empty units. Also, when interest rates are high, it can be challenging for property owners to refinance their loans. contributing to a significant financial burden. Ultimately, interest rates that are too high might be detrimental to the overall real estate market. Supply and demand dynamics are another channel via which inflation can influence commercial real estate. When inflation is low, tenants have more purchasing power, which means they can afford to pay higher rents since they have more money to spend overall. Because of the increasing demand, prices for commercial real estate may go up. In addition, the converse is true when inflation is high. Prices for commercial real estate may fall because tenants cannot afford the higher cost of living brought on by inflation. In the end, these factors interact with one another in complicated ways. It is obvious that factors such as high interest rates significantly impact the demand and supply dynamics of the market for commercial real estate. What other variables are contributing to the impending crash of the commercial real estate market? The COVID-19 pandemic has not only been a driving force behind the rise of e-commerce, but has also forced us to adopt more e-commerce behaviors. E-commerce has brought about convenience and has caused a shift in the way that we shop, and this trend is only expected to continue growing. The United States Department of Commerce reports that there was an increase in online retail sales of more than 30% from 2019 to 2020, bringing the total to an estimated $791.4 billion. Not only does this affect how we go about our daily lives, but it also has repercussions for many other businesses, including the commercial real estate market. Because of the development of e-commerce, businesses are now opting for smaller retail spaces. Over the past few years, it has become increasingly obvious that businesses are finding it increasingly difficult to maintain their physical locations due to the rise of online retail. Because of the growth of online shopping, many traditional stores have to consolidate their inventory or even close entirely. Even though there are some businesses, like supermarkets, that will always require a physical site, there is a tendency across the industry for smaller retail spaces. Having less space means having fewer goods in the store, which in turn encourages customers to purchase online in addition to purchasing in physical locations. During the COVID-19 lockdown, hybrid shopping, in particular, saw a significant boost in popularity. During the pandemic, combining online shopping with curbside or in-store pickup provided shoppers with an additional level of convenience as well as a safe way to purchase. Even though restrictions have been relaxed, people still seek the ease of this approach of shopping. The downturn in the commercial real estate sector is intricately linked to the profound behavior and structural shifts ignited by the pandemic. The realization that densely populated and confined spaces can pose health risks have spurred a reevaluation of traditional office environments. A new appreciation for the safety and convenience of home offices has taken root, with many relishing the ability to work in a more relaxed attire without the commute. Industry surveys from corporate entities and property owners indicate a significant trend, a preference for the flexibility to work remotely, which gained traction out of necessity during the health crisis. Only a small fraction of the workforce is showing enthusiasm for returning to a pre-pandemic office life. The majority seem to have embraced the new normal, favoring remote work arrangements. Companies, recognizing the cost savings on office space and the potential for improved employee satisfaction, are increasingly adopting remote or hybrid work models. This pivot, while beneficial for operational budgets and worker contentment, could spell a transformative challenge for commercial real estate. The evolving work landscape is diverse. Some companies are fully remote, others have returned in person, and many operate on a hybrid model. These changes are altering demand patterns for office space, impacting leasing rates and investment returns. For commercial real estate owners, this represents a stark departure from the steady demand seen in pre-pandemic times, introducing a level of uncertainty that the sector must now navigate. This shift not only influences current market valuations, but also has the potential to reshape urban planning, commercial property development, and investment strategies for years to come. Well, we're in it, and the commercial real estate crash has already started. Don't forget to hit the subscribe and like button, and by the way, don't forget to turn on your notifications so that you won't miss out on our next videos. Until next time!